Hey everybody, it's Pete. Welcome to Stock Trading Pro. Welcome to the Daily Ticker. Joined by David Trainer from New Constructs. Thank you, David. How you doing today?
I'm doing great. Thanks for having me, Pete.
We have a great show for you today. I actually wrote it down as usual. Don't want to miss anything. We have earnings season about to start. So we're going to hop into a little bit of a bigger picture story about macroeconomics, really more specifically the liquidity cycle and how does the Fed own the market right now, where it's the direction of what the Fed is doing with liquidity. Is that really what we should be paying attention to? Or should we be paying attention to earnings a little more specifically, or both, quite honestly, in different moments? We're going to have a good discussion on that and how to trade around both of those circumstances. Then we're going to get into the New Constructs 4 Steps to Value Investing 2.0. We're going to go deep dive into David's stuff today, which I'm really excited for you to see this today. The 4 steps, starting with economic earnings versus accounting earnings. We're going to break, you know what? We'll let David, I'll break them down. And then finally, the thing that probably everybody watches YouTube for, the S&P 500 stocks most likely to beat. That's the part that everybody's really juicy about because we get those in the comments all the time. So David, obviously, welcome. Very grateful to have you here with us today. So we had a little bit of a conversation around this, and it's a constant conversation that we have in our community. With today, the Fed minutes just came out. And everybody watching it like a hawk for what they said versus what they didn't say. And it's a bigger conversation, which we personally in our community saw in a big way in 2021, which was as long as that liquidity cycle it kept pumping liquidity into the market, there was virtually no chance the market was going to go down in 2021. And then when they announced in early November that they were going to stop quantitative easing, we were talking to everybody in our community, get ready to either understand how to short sale, hedge, or buy puts because we're heading in the other direction, because the very reason that the market was going up, all of that liquidity was going away. Then you have earnings season, which is just about to kick off right now. And we've seen, obviously, Q2 of this year, 2023, AI, the hot story for the year. Probably a lot of stocks got overvalued in a very, very quick way where algorithms were kind of piling on top of each other. So we're going to have this conversation, and I think that we might even have a little bit different perspective, David. Is it macro liquidity cycle that we should only be paying attention to, or at what point do earnings matter just as much, if not more, for how we're deciding to invest? Macro versus earnings, especially because we have earnings season coming up now.
Yeah, I wish it was as easy as either or all the time, but I think to your story, what you saw unfold in 2021 with, so many new highs and how stocks just got ridiculous and it was a silly environment. But then when the liquidity trends changed in 2022, we saw a big reversal in all that performance. And so I don't think fundamentals really matter that much as long as the Fed is pouring enormous amounts of liquidity into the market. I believe that's where the greater fool theory takes over. And what matters most is order flow. Now, I do believe, though, that when the liquidity gets a little bit lower, it's like when you start to drain water out of the pool, you see who's wearing trunks and who's not. Mm-hmm. Lower liquidity means individual company fundamentals matter. I like to think about the liquidity from both the monetary and fiscal perspective, right, as the tide in the ocean, right? And the companies are boats. And when the tide gets low, you see which ones are smart enough to navigate the rocks. And that's when fundamentals matter. And I think that we're going to enter into here in the third quarter, Pete, a period where fundamentals are going to matter a lot because the Fed had to effectively reverse a lot of tightening and rate rises over the last couple, year or so by easing a little bit, easing a lot to make sure no more banks went under. Right, they had to stop all our processes. Let's make sure no more banks die, because that was a bigger threat to the system. And then there's been also a cutback on fiscal stimulus. I mean, nothing, a lot, but the first one that comes to mind is that we're not going to be paying back or paying off these student loans for people.
Yeah,
I think some of the emergency COVID measures have ended, so people got to pay rent again. So these things are going to create less liquidity. And as that liquidity becomes lower, fundamentals will matter, and they will matter a lot. I think the market will be brutally honest about fundamentals. When there isn't so much liquidity, we can just kind of paper over it all.
So how would we describe then how does that translate into making a decision? And this is the way that we describe it. Let me know if you think it's kind of the same thing. the type of catalyst that you are looking to make a decision on will eventually dictate the objective for the trade or investment, whatever it happens to be. But in this case, I think far too many people are using long-term macroeconomic news to make short-term decisions, and I just think that's wrong, completely wrong. The Fed is not going to turn the market around next week. It doesn't work that way. But I think that earnings, and again, we're kind of hopping into earnings season right now. It's about to start. I think next week we actually have a much bigger scheduled releases. Earnings are a lot more actionable, for lack of a better way of putting it. We've seen a lot of them where they gap up, gap down, and kind of go in that direction over the next 2 to 3 months until the next report, which kind of takes us now into new constructs and what David specializes in, besides the stuff in the footnotes that nobody wants to get into. That's kind of their specialty, is the 4 steps that you are calling value investing 2.0. So I'm actually going to read them all. I'm going to read all 4 of them, David, and then maybe you can go down each one and give them a little bit of context. So we have economic earnings versus accounting earnings. And I'll just give a little bit of flavor on that and let me know if I'm wrong. Accounting earnings is the common earnings per share that everybody loves to obsess over, that kind of stuff. Is that correct?
Yes.
Okay, so number 2, we have the power of quantifying market expectations. And again, from what I've learned from David's stuff, is market expectations is the stock price itself will give us an idea of the growth appreciation for that stock. So again, if you just think about it from a mom and pop store, certain stores will have a certain amount of time that they have a competitive advantage. So the market will reflect that back. Number 3, discounted cash flow and how that works. And I guess, David, discounted cash flow versus reverse discounted cash flow, is that different or is it semantics?
They are different. We use reverse DCF, and we use that reverse DCF model to quantify market expectations.
Okay, awesome. And then the last part, something that I've been reading up on a lot lately, return on invested capital. And actually, ironically, I went today, what's the difference between return on invested capital versus return on capital versus return on equity? You could kind of get lost in that maze there. So I guess if you want to start at the top, David, step number 1 for new constructs, economic versus accounting earnings.
Thanks, Pete. Yeah, this is not a new concept. I mean, Adam Smith wrote about it in Wealth of Nations. Kind of all of the market gurus or investing gurus have written about this for the ages. And that simply recognizes the fact that the income statement or any one of the financial statements is not enough to understand the profitability on their own. You need to look at the full financial picture, right? Just looking at reported accounting earnings from the income statement, that's like a doctor trying to diagnose your health just by looking in your ears. Right. And so what you want to do is look at income statement, balance sheet, cash flow statement, and as I've said many times, the footnotes. The footnotes are huge. I mean, there's papers out there now that prove that, if you're not looking at the footnotes, whatever you think about earnings, even core earnings, could be very, very wrong. So economic earnings are about taking into account the entire financial picture to really have a wholesome view on the profitability or the health of a business. And it takes a lot of work to do that. Not a new concept. Wall Street doesn't want you to do that because they'd rather you focus on the version of the profitability, whether it's looking in your ears, looking in your eyes, or just, listen to my lips. You know what I mean? It's more like going to the doctor and the doctor making a decision on on your health based on what you tell them, right? Because Wall Street's telling people stuff all the time.
Right. That's actually a great way to word it.
Yeah.
You're almost influencing what you want them to hear.
That's right. Right. It's because it's nobody's really even looking in their ears. They're just listening to what the narrative is. So that's accounting versus or economic versus accounting earnings.
I know this is kind of off the cuff, but can you give an example of where earnings per share might not be telling the whole story? Because that EPS is what EPS came out and guidance. EPS came out and guidance. Can you give an example that might be coming to the top of your head where EPS was, I don't want to use the term misleading, but kind of missed it?
Yeah, I mean, we just published a report today on the 5 companies in the S&P 500 most likely to beat, and we do a deep dive. If you ever read any of these reports from us, you'll see there's a deep dive on at least one of the companies on the list. And this quarter, we did a deep dive on Moderna, and what we found is that there's about $4.13 of earnings distortion total. 457 cents of distortion net comes from the footnotes. That's 1.9 billion in inventory write-downs that you can see over the last 3 to 4 quarters. And so, this is just our way of showing folks that there's a lot of information that is causing the reported GAAP earnings to be much lower than the core earnings. And the same is true in the street earnings, Pete. Like a lot of times, the street's not adding any value, right? Supposedly the street's supposed to be a smarter version of earnings, right? But the street earnings are just as depressed by these unusual items. And so you see our core earnings number is a much bigger and different number.
So what does that imply? I guess that's really the biggest thing. Like everybody wants to know, what does that mean? How do I use it? If again, this is all for financial education. Everybody has to make their own decision. What does that much bigger blue line mean to somebody who understands what they're looking at?
It means that that company's more likely to beat their number, to beat earnings. And when companies beat earnings, they tend to go up. So Moderna in our system gets a beat earnings distortion score. So if you look at our rating here, you'll see a strong beat. And that's, it also gets an attractive rating. We like those two things to be in combination.
And that stock, I could tell you from having looked at that on the charts pretty much every day, has been getting beat up basically since December. So this might be the quarter to start looking at it. Yep.
They've taken a lot of write-downs, that's for sure. And it's really depressed their numbers. And we think there's an opportunity to beat. And most of this is in the footnotes. So this is really good. When the hidden distortion is the majority of the distortion, that means you've got an even bigger advantage, because a lot of times when we see a lot of it reported unusual items, a lot of times what we'll see is the street is getting a lot of those because it's right on the face of the income statement. And sometimes yes, sometimes no. I mean, the street misses a lot of those too. But the footnote stuff means you're really, you're looking at this report, you're basically getting almost, it's legal, but it's like getting inside information because studies have shown that the market is not paying attention to footnotes. So if you've got information from the footnotes, then you have an advantage.
Okay, excellent. All right, so let's kind of hop into that now. Quantifying market expectations, step number 2.
Yeah, I think, look, investing is buying low expectations and selling high expectations. And Pete, this is from a fundamental perspective. If you got order flow, right, you're selling or you're buying wherever the flow is going. You're selling where the flow is decreasing. Mm-hmm. And the better you can anticipate how changes in order flow are going to manifest, the better you can take advantage of that. When it comes to investing for fundamentals, you want to buy stocks whose prices imply lower cash flows than what you believe to be the future cash flows of the business. And you want to sell stocks whose prices imply higher cash flows than what you believe to be possible for the business. And so that to me is just a much simpler way to think about valuation. Buy low expectations, sell high expectations. And that to me at the end of the day is, that's what good fundamental research is all about.
It's interesting too, from a paradigm perspective, where the way that we look at things, and David, we spoke about this just before we came on the air today, of the difference between a fundamental investment and the expected time for that to play out versus what I do, which is mostly sector rotation and reading order flow. The way that I do things, and it's a big part of what we do, is we don't predict. We just pay attention to what's going on right now and put the pieces together for how likely is that to continue versus a fundamental investment that, well, I'll just use the word undervalued just for the sake of this conversation. You're not necessarily predicting, but you're making a very educated guess, for lack of a better way of putting it, that there's a good chance that's going to go up at some point in the future versus it's going up right now. So it's kind of an interesting way to put those two pieces together.
Look, in a world where we can't predict the future, what other choices do we have, right? We have to look at likelihood. And you're talking about the same thing that I'm talking about for fundamentals. Yep. And I think the likelihood of a stock going up for fundamental reasons, when that price implies huge increases in cash flow, is very low. On the other hand, if that stock price implies a permanent decline in cash flow, well, then it's much more likely that company will beat those low expectations. And for us, we're always trying to help people with risk reward, because if we can't predict the future, we position ourselves in the best way possible with respect to risk reward.
It's actually interesting getting into risk reward because we were just talking about that the other day. The real risk in a trade is not knowing what you're doing. It's really the quality of the idea and really understanding how you came to that conclusion. That's really where the real risk of a trade is. If you have no idea what you're doing, you shouldn't be doing it in the first place. And even people that know exactly what they're doing, there's still risk, but it's quantifying that risk and how much you want to put into the deal based on the information you have in front of you right now.
I mean, I can't agree anymore. I mean, look, the real risk is ignorance, right? And not taking into account the information you need to make an informed decision. That's the way we operate, right? I mean, the risk of not looking through filings is footnotes. The risk of not understanding cash flows and valuation is not, buying things that are going to get blown up.
Mm-hmm.
And yeah, I mean, that's part of our mission is to help people make better decisions by providing them with sort of the basic information needed to make intelligent investment trades.
We have a question that we ask new people that are considering coming into our community. Oh, I don't need coaching. I don't need this. I don't need that. Well, I'm like, well, you just hired yourself as a money manager. What experience do you have? And that just completely changes the conversation when you reframe it that way.
That's great.
So, okay. So that was market implied expectations. Now, discounted cash flow model. How does that work?
So that's how we connect the dots between whether or not expectations are high or low, right? There's simple ways to do this, PE ratios and other metrics, but the real way to do this is to use a reverse discounted cash flow model, Pete. And when you do that, you really can get a real sense of whether or not expectations are too low or too high. If you want to share my screen for a second, I'll demonstrate with a recent long idea that we wrote up for fundamental reasons. And you can see this is the profits of Nucor, right? Historically on the left. And the current price at $186, $196 a share implied this blue line of future cash flows. I'm sorry, the red line of future cash flows is the current price, right? So we're pointing out that if you believe the stock is equal to what the market price has it trading at, $150, you got to assume there's a major retracement in the profitability of this company. If you assume that it just does just a little bit better than that, you're looking at almost $200 a share. And it is still a pretty major retracement of the past profitability of the business. So the idea here is that the reverse DCF models will help us have a very explicit, objective, mathematical assessment of whether or not expectations in the current stock price are too high or too low. And we just think that that's awesome. Like I can go in and show you the math right behind these models that will explain exactly why, what has to happen about the future of the company for it to be worth $150 or $196. And then whether or not you're buying low expectations or high expectations. But a reverse DCF model is a critical step in being able to make that kind of decision.
So on the screen, just in case somebody doesn't understand NOPAT, can you give us a quick rundown on NOPAT?
That's the net operating profit after tax. That's a core element of economic earnings. Okay, it's a core part of economic earnings, and we look at NOPAT typically instead of economic earnings because economic earnings tend to be much more capital. They're very much more capital intensive in terms of what they're capturing, and that doesn't necessarily. The free cash flow model is doing the same thing, so it sort of double counts. NOPAT's an easier sort of top line number to measure. We also need to do NOPAT a lot of times, Pete, on the expensive stocks because they've got negative or terrible NOPAT. And so the future NOPAT implications are like so disjointed, or I'm sorry, the cash flow numbers are so disjointed that NOPAT makes it a little bit easier because it doesn't take into account the capital. But yeah, net operating profit after tax, sort of the number that most people are more familiar with, even more so than economic earnings.
Okay. So now we're going to get into the step number 4, a new paradigm for return on invested capital.
That's just coming back to why our technology is important, why things like economic earnings and return on invested capital and NOPAT are hard to calculate and why you need technology to do it. And our belief is that we are helping drive a change that we think will eventually become self-fulfilling as more people recognize that they've got access to these high quality measures that take into account footnotes and are more indicative of the underlying value of a business. They will begin to rely on them and trade more of them. And as more people trade more on them, people will see more of the market react to them. Just like we see people react to FOMO, people, I think, will start to react to reliable fundamentals, access to reliable fundamentals. And as more and more of that happens, people become more naturally just educated and attuned to the fact that, oh, wait a second, it's great for me to understand fundamentals because it's just going to make me a smarter investor. I'm going to take less risk. And,
I'm sorry, go ahead.
And we think that we're bringing that new paradigm into market, Pete. That's our goal. And if you look at a regression analysis, the single biggest driver of return of valuation, changes in valuation, is return on invested capital. The market assigns value to where it gets the most back. In other words, if you give a company or manager $100, two managers $100, and one of them generates $1 a year, and the other one generates $20 a year, who are you going to give more money?
Right.
The market thinks the same way. That's what a capital market is. That's what the invisible hand is. So to the extent you have a source that can reliably measure what that numerator and denominator are, or return on invested capital, then you've got a better mousetrap for picking stocks.
So we did have a question in our community beforehand, the difference between return on capital versus return on invested capital. And correct me if I'm wrong, this is the way we were talking about it before. Return on invested capital is net profits and the return on that. Return on capital includes more equity and borrowed money. Is that correct? Or is that an oversimplification?
There are so many different ways of measuring return on capital, and ROE and ROA and RONA and ROTC and all that. It's, what I like to say, Pete, at the end of the day, is that there's one version of the truth, and that's what we aim to provide. Ernst & Young wrote a white paper proving that our measure of return on invested capital is best in the business. No one goes to the trouble to get return on invested capital more than we do, get it right more than we do. And so it's hard for me to say what the differences are because everyone makes up their own formula,
right?
Including at the executive level and the corporations, right? A lot of companies, we have a model portfolio that focuses on companies that pay executives based on return on invested capital. And we have to actually make exceptions and call out those companies that say they're doing it, but then their measure of return on invested capital is so poor and has so many sort of call outs or like compromises that it doesn't even do a good job. So the concept is not that new. The implementation of the concept with integrity and scale is what we do that's new.
Okay, excellent. So those are 4 steps. Well, actually, what I'll do is in the footnotes of the video, I'll provide a link to this spot on new constructs if somebody wants to do a little bit of a deeper dive into this. Let's finish up, David. That's S&P 500 stocks most likely to beat. We have earnings season coming up. Do you want to share your screen for that, or you just want to run them off?
Yeah, so we did a deep dive on Moderna. They're the number 1 stock on the list, but you can see the report we just published today. This is private to our clients and Pete's audience. But yeah, you can see that we got 5 stocks, and this is how much the street is underestimating each of these stocks. And some of them a big amount, some of them a small amount. But we are going to soon be publishing in a couple of days the 5 S&P 500 companies most likely to miss because their earnings are most overstated. And we actually like to track on a regular basis kind of what it looks like for the overall market in terms of the percentage of companies whose earnings are understated. You can see here during the financial crisis and the kitchen sink effect when everybody was cutting their earnings. And we've seen a bit of a kitchen sink effect here in 2022. And then companies taking advantage, I think, of the excess liquidity to attract attention and see their stocks go up, where they're taking some of the gains here and overstating. And now we're seeing a return to understating, which will probably set up another market downturn in general. Yes, so 5 stocks most likely to beat here, and the ones most likely to miss will be out later this week.
So Moderna is an interesting one. We actually, in our research today, healthcare getting hammered and seeing some big moves to the downside. So it's interesting, that whole group of stocks getting hammered right now, and that stock happened to be in that list. It's been in our short sale category for, like I said, probably for 7 months now. And they actually tried to prop it up a little bit. There's I want to say about 2 weeks ago, there was a positive news story and the stock just couldn't catch a bid at all. Very similar to what OPEC is trying to do with oil right now. But maybe we'll see. We'll actually see if it ends up catching the bottom down there. So I have one other question, just following up. So stocks most likely to be, let's say somebody is coming into the new constructs universe, and you have stocks likely to beat and stocks on the other side of that. If somebody was coming into your universe, and where is the smarter place for them to start? And again, educational purposes, everything we talk about. Should they be punching in the stocks that they own to see if they are grossly overvalued, or should they be to kind of have an alarm go off in their head, or should they be more excited about stocks that are undervalued?
I think the first step is to put the stocks into the system and see what kind of rating they get. Earnings distortion scores are really just about earnings season and the short-term pop or dip you might see for a beat or miss. Our overall risk reward rating, very attractive, neutral, unattractive, and very unattractive. That's a much more longer term and comprehensive perspective around stocks. So that's where you want to live, and you first want to understand what's in your portfolio. So we recommend you put that in, see how much green, see how much red you have, and then on the margin, I think you want to move toward more green than red.
Right. Okay, so again, that's kind of funny because getting back to what we were saying before about trade objectives, you have to start with where you are now. Like that's like one of the biggest what's the word I'm looking for? It's very common in our industry for people to not admit where they're starting from. And if you could punch your stuff in there and see where at least now you at least have some framework for making a decision, which kind of removes all the overwhelm as well. One thing that we say in our community is when you know what you're looking at, you're never lost. You still have to learn how to use it, but if you know what you're looking at, you're never lost. So that's kind of getting back to the same thing. If you have a framework for where those stocks are rated, at least now you have a reference point to make a decision from, as opposed to a feeling or a headline that you might have read somewhere. That's
great. Yeah, it's probably hopefully very comforting for people to not have to be lost from a fundamental perspective. At least know the risk you're taking. And again, as I said at the beginning of the show, order flow, liquidity can override fundamentals for a long period of time, and it certainly has for certain stocks. Eventually, though, fundamentals do matter.
All right, we covered a lot today. Anything we talked about today, I will put in the footnotes, especially to dive into a lot more of the education on new constructs. David, any stocks that earnings season starting next week? Obviously, I think the banks actually start next week. I know you like JP Morgan. Anything else in that particular sector?
We've talked about a few of these. Discover's been one that we put on our long list. Same with Zions, Bancorp, and Schwab.
Schwab as well. Schwab's had a 50% haircut since the whole regional bank thing took hit.
That's right. We think it's undervalued. We think it's just getting beat up, and this is a great business, one of the best businesses out there. And they do things the right way. I mean, I know folks that work there, and the kind of money management approach that they espouse, they're much more honest than your legacy Wall Street firms. And I think that's a good business. I think Zions is a good business. They're both super, super cheap. Discover's been a great business. It's actually already come up, I think, 30 or 40% since we put out our long idea. Schwab and Zions are a little more recent.
Yeah, we've actually been credit services in general has popped up for us probably over the last 4 to 6 weeks. We've had Capital One, Discover, Visa, MasterCard actually exploded a little bit recently as well. And then even PayPal's been kind of hanging around after bottoming out. It had a big breakdown probably around 4 weeks ago after earnings, slowly drifting back up into the 70s. So groups moving together are usually a good place to start. There's a lot of order flow going in at the same time. It's something you want to pay attention to.
Yeah, absolutely.
All right. We will wrap it up there. So we covered macro versus order flow timing. We got into the 4 steps of value investing 2.0 by New Constructs. I'll provide that link below. And then the 5 stocks most likely to beat, published by New Constructs. And obviously, David, thank you for sharing that with everybody today.
My pleasure. Great to be with you, Pete.
All right, everybody. Thank you so much. We'll speak to you soon. Take care.